the many participants in the shipping industry with each other. It's very impressive what Caldawalader and Christos have done with this conference and others. So thank you. As we all know, the shipping industry has suffered through a prolonged downturn that has recently begun to turn in a handful of subsectors, generating cautious optimism. As opportunities return to the shipping industry, the landscape of suppliers of capital to the shipping industry is looking very different than that which preceded the cycle. Several major banks have pulled out of shipping altogether, while others have cut back exposure. Increased costs associated with green shipping initiatives, environmental regulations, and technological improvements have resulted in increased need for financing in the industry. So that's the backdrop, I guess, with which we'll ask these esteemed panelists the following questions. Let's get right into it. I'll start by directing a question to Nikos Papanestis. From DNB. A number of banks have exited the shipping industry altogether, and others have curtailed their exposure and participation. For those banks that remain in the shipping sector, how does the market look going forward? What are you seeing as the current major challenges and opportunities for the industry in your bank currently? And what have been the lessons learned from the perspective of a lender since the downturn?
Starting from the... Yeah, taking a step back, first of all, the last few years we have seen that the banking financing model has improved. The first one was, for instance, banks lending to companies which were very robust, very low credit risk. But the terms were very, very competitive and low pricing terms that lead to very thin returns. On the other hand, you have banks who are lending to lower tier companies, mid to lower tier companies, and this has resulted in this has resulted in increasing the risk of taking losses on the portfolio. And this, combined with the market cyclicality of shipping and the capital intensity of the industry, this has led to banks taking losses over the last years. And this has resulted in the banks not being able to absorb the swings of the market in the balance sheet, and they had to downsize the portfolio or even exit. On the other hand, we've seen lately some banks that are very competitive on the pricing, and we're talking about 3 or 4 banks at the moment, and the number is reducing, which compete for the very, very strong credits. But we also see this as a challenge, coming to your question again, because the models are recalibrating in the banks and the capital allocation is increasing. So we see this trend diminishing as well. So we as DNB, we have been focused less on volumes and more on profitability. And we find the solution in maintaining a sustainable business model by combining the use of balance sheet, but also with advisory and investment banking products. And we have seen this pay dividends to our bank over the last year. Having arranged a number of transactions on the investment banking side, we are very focused on a selective client group of around 120 names with a portfolio of 8 billion globally. And this is where we're going to place our resources going forward in order to make the sufficient return for the bank. Now the last part, which is lessons learned over the last years. I'm not a big fan, of taking a stance after or post-mortem of the situation, but I believe, that committing to long terms in the past, committing to very specialized lending structures, and having the wrong counterparty to deal with, I think these have been the major lessons learned over the last years.
On the subject of lessons learned, maybe we can talk as a group about a subject that where the banks may play a very pivotal and important role, which is the size of the fleets within the various sectors. as a lender, do you prefer to lend to owners who are looking to acquire second-hand vessels or new build vessels? And when you make those decisions about whether or not to lend into those situations, do you think about do you consider more the size of the fleet and the impact on the industry, or are you looking more at sort of the quality of the asset and how it would serve as collateral? I'll start by directing to a lender director.
Okay. So when we lend to someone, we lend to successful ship owners, and not to ship owners who want to do new buildings or second hand. So the first thing we would look at is the record of the counterparty who comes to us with a proposal. So, and that will be a key factor. So, if someone has a very good record of actually placing new buildings and be able to, secure good employment for them and be resilient during the crisis, this is very important. And that's what we look at. Yes, you could argue that they've been ventures where, they basically had a negative contribution to the market by ordering too much, 20, 30 plus vessels, and often, with other people's money. However, in retrospect, now you have a good record of whether, this has been a good strategy or bad strategy, and therefore, you can actually make a choice as a lender whether this is something you can support or not. The reality is that you want to lend to good vessels, and the reality is, someone who has a good record of being able to secure good employment for new buildings, or being able to trade them well. You have a vessel, you have a security that has a longer time period, has better specs, so that means that they could potentially secure better rates when the vessel's on the water, and so forth. Whereas the second hand, it has some risk, especially now with the new technology coming into play, the eco types, the ballast water, the scrubbers, that it could have a shorter time span where it could trade well. But again, at least for our bank, the strategy is that first look at the counterparty, see whether they have been able to perform well, and what is the trading aspect. They know the strategy, and the strategy plays well, then this is someone we will support regardless of whether they want to do new buildings or second hand.
Iraklis, how does ATB think about new build versus second-hand acquisitions? And is it also doesn't really matter as much? It matters who the buyer is. Quality buyer, it doesn't matter what the vessel is.
I think Eleni said it very well. I don't have much to add. It starts with a counterparty. I would say new buildings is not for everyone. You need to have the financial stability and the pockets to do that. Because we've seen what has happened if you go and order a number of vessels and you don't have the employment secured, and then the market turns, and it's a quite difficult situation to cope with. So I would say that it's not for everybody, and certainly the groups that they are keen to go out there and secure some slots for new buildings, in order also to comply with the new regulations and be at the front run when it comes to environmental aspects and look green and actually do something good, at least from an environmental perspective. Again, that has some restrictions, however, because they might be pushed in a situation that they have to secure long-term employment in order to get the appropriate financing in place. So nothing really unusual compared to other lines of virtual button products. Just on the point of the second hand, obviously it's like a car, if you would like to have a bit more conservative approach to expansion, then a second hand is always better because downside risk is more limited compared to a new building. And at the same time, you can enjoy the same pretty much rate if we're talking about the conventional segment.
So Nikos mentioned something in his remarks. He said that DNB really focuses only on 100 counterparties globally, and what that suggests is that you're looking to work with the largest potential counterparties and not necessarily smaller owners. At the same time, there's very closely related to the subject matter of fleet size, overall fleet size, has been the trend towards fleet consolidation. Consolidation through mergers and alliances has been a continuing trend in the last couple of years, and as of June 2018, the top 10 shipping lines in one sector controlled 70% of the fleet capacity. do you believe that that traditional shipping banks have contributed to this trend? I'll direct this to Iraklis. Do you believe that traditional shipping banks have contributed to the trend of consolidation? And does that mean that that smaller owners, the 2 vessel owners, the 6 vessel owners, the 10 vessel owners, in order to get the attention of bankers like you, need to grow their fleets or merge their fleets?
No, I wouldn't say that you need to grow and become a big player in order to get financing and be competitive enough. On the contrary, I think there are a number of small family-owned enterprises that have done even, not just slightly better, but considerably better than some of the bigger groups. Because they have the flexibility, they were able to adapt their strategies along the way. They were also able, quite a few of them, to ride the cycle very successfully, enter the market at the right point and exit the market at the right point, or downsize their operation at the right point in time. So I would say this answers the question whether size matters. It matters in some aspects, maybe economies of scale, and maybe some other synergies, if they can achieve. But whether a small company can keep going, I think that's doable for sure.
Direct the next one to Eleni. We hear from ship owners that significant expense is required to improve vessels to meet the expectations of clients and regulators. Most of this morning was a discussion on various panels about scrubbers and environmental related technologies. Is it difficult for lenders to provide financing to facilitate those upgrades, or have those processes been worked out?
Okay. So I'll start by basically saying, we talked about the counterparty before. I think the other 2 aspects that a lender is looking at is basically, again, whether the vessel is able to trade well for a long period of time, and means to secure good employment. And the last thing is the quality of the vessel. And the investments, be it scrubbers or water ballast treatments, etc., whatever else, actually do ensure these 2 aspects. That first, the vessel is able to trade, be compliant with the different regulations in the different parts of the world, which is a new reality and necessity. The second aspect, so that means good cash flow for the repayment of the loan. The second aspect has to do that basically you enhance your own security vessel, and God forbid, if there's a downturn and you have to exercise security for whatever reason, you have a much more liquid asset, or even the ship owner, not in enforce, but the ship owner themselves are able to sell with a premium versus and a vessel that is not invested. So I think fundamentally these are things that the banks would like to support. It makes good finance sense. The problems we've run into is some structural aspects. So for instance, when someone has already an encumbered vessel, has already a mortgage on that, and they come to you to basically finance the scrubber installation, clearly the current market value is not sufficient to support the additional investment. So you have to come up with ways, almost take a leap of faith that yes, I'm doing I'm basically doing a little bit over my asset cover ratio, or I trust the counterparty, going back to the previous theme, because I will see this investment being translated to an upside in value in a year's time or whatever have you. We've seen also structures where basically owners do the installations themselves and they come afterwards in retrospect to secure financing as an equity release. But in our mind, this is a little bit counterintuitive because it's almost like buying a house. You can't just if you don't have the equity, someone will need to help you buy the house first, and then have something which is sellable, liquid, that can operate, etc. This whole agenda also fits very well with the new strategy of banks around sustainable financing, which is very key in the sense that we banks also have a responsibility to society. It's not just the ship owners. We need to do our own bit to ensure that we help to go into a better work environment for ourselves. So I think it does make sense. It's just that structurally, we need to think of new ways, and we need to perhaps amend a little bit the ways we've been providing the regular, the typical type of financing in order to be able to support these much necessary investments.
So without stepping on the toes of the next panel, which will focus on capital markets, there has been a trend of new alternative financing providers entering the shipping industry during the downturn. There's been hedge funds, private equity funds, leasing companies, etc. How have the traditional shipping banks responded to this competition? Do you think, from a bank's perspective, and I'll direct this to Iraklis, do you think from a traditional shipping bank's perspective, you have to be more competitive to deal with these new entrants, compete with these new entrants? Do you think that as markets improve, they'll go away, or is this a permanent part of the financing landscape, and how will the traditional shipping banks cope?
Sure. First of all, I think I should say that the shipping finance market, in my view, is at a better status than a couple of years before. There are plenty of options out there, all kinds of structures available, which was not the case a few years ago. And that's great, because depending on the needs and the requirements of each group and each lender, there might be different pockets and sources to tap for the various occasions. I represent ADB, which is a small boutique financial institution based in Amsterdam. We are not nowhere near to HSBC or Nicola's company, so definitely there's a market for everybody. Definitely there are going to be needs, different needs from each group, smaller groups, bigger groups, listed, private, that can cater better for the various funding options on the table. Some of them might need higher LTVs, some might be more minded on the lower cost of the funding. So there can be different regions and different needs. So definitely the answer to this question is I see a need for everybody pretty much.
If I may add something to that, I think there are two aspects. I mean, first, I wouldn't say that the traditional commercial banks see these hedge funds or private equity funds as competition. I mean, they're there to fill a gap, a void that has been created because of the departure of several traditional commercial banks from the industry. So, when, basically, Nikos, mentioned that effectively, they're focusing on fewer clients versus a year before, or a couple of years before. Someone needs to cover that gap, and the reality is that this is mostly the mid-size, small-size owners that their access to funding is more constrained, and this is what the hedge funds come to do. But they do it at a price. They have a premium. The hedge funds, their return on their investments, their IRRs, are much higher than what you would see from a traditional lender, and that means again that it's not a solution for all. The second thing that needs to be taken into account is that because the hedge funds, they're not necessarily driven by relationship reasons, which is what drives the commercial bank, discussion with the owners. So again, one of the things that, is a little bit untested, but I think will be critical for the future, is that in the next downturn, which will come inevitably, because it's a cyclical sector, how these alternative finance providers that basically, are offering mezzanine type capital, high pricing, will actually react. And whether there will be a discussion that, this is no longer your vessel, I own the vessel, or whether they will be happy to go into a solid discussion, sensible discussion, and say, we're partners for the long run, let's try to find a solution, which is typically what a traditional commercial shipping finance bank would do. So, not necessarily competition, different market.
And just to add that technically, in many cases, private equity firms own the vessel because those are sale and leaseback transactions. So then, just on a day, there might be just a change of management, change of everything.
Yeah. So I'll ask two more questions, and then I'm going to go to Q&A from the audience. I want to move things along and finish within the time or before the time allotted. The first of the last two, I'll ask a technical one that's of interest to me because my law firm serves as counsel to the Federal Reserve's Alternative Reference Rates Committee, which is developing contract language to replace LIBOR before it ceases being used. The shipping industry's vessel loans typically are taken on the basis of a premium over LIBOR. Iraklis, how is ATB preparing for this shift? How are you in connection with, I would say, new lending arrangements and existing arrangements? Do you have a plan in place to deal with the ending of the LIBOR cycle?
I would say it's like Brexit. Everybody knows about it, everybody talks about it, nobody has an idea about what's going to happen. So What we have seen, and LMA, the Loan Market Association, is spending quite a bit of time on this matter. There have been all kinds of suggestions on the table, and none of these has been crystallized. There are some limitations on the various proposals that have been put on the table. One of the things for sure, I see the language which is currently in the loan agreements that says that if LIBOR is going to fade out, then the parties need to sit down and adhere to a market standard approach, whatever is the new approach. I would say this is the typical language that probably will continue to exist in the loan agreements. I'm not sure, Nicola, then you have seen something different in that respect, but yeah, it's a bit open-ended. Nobody knows exactly how this will develop going forward, but I think it's addressed efficiently.
And I guess that the no-deal option is not on the table like Brexit, so we need to find a solution to cover the funding costs.
Yes, if I may ask the panel one question which I don't think was covered. Since you're referring to traditional financing, and you, Eleni, placed a lot of emphasis on the fact that you're looking at the quality of the client, the track record of the client more than anything else. Does any of you have any comments on the idea of the perception of how you've changed leverage? Because years ago, traditional banks, basically were doing conventional finance, 50, 60, 70%, it would depend on the quality of the client and the cash flow and the income of the ships. But do you have any general policy in terms of leverage? Because I think that makes a big difference with regard to the alternatives, where you have the other funds, which are a bit more what I call heavy duty, and sometimes throw too much money aggressively and too high expense. So I just wonder whether you happen to draw a full comparison before we go to the next panel. Thank you.
Sure. If I may start, I mean, HSBC is known to be ultra-conservative, so, basically we were doing the 50, 55, 60% LTVs when everybody else was doing 80% plus in the market, to be honest. So nothing much has changed for us. And the reality is that this has been proven to be a good strategy, like in the downturn, in the sense that you have some buffer, not always sufficient, but you have some buffer, when the vessel, when the value of the vessel drops. We see the banks coming back and actually adopting the same strategy as you mentioned in the last few years. And I think this is going to stay. And it's not going to stay just because of prudency for credit reasons. The aspect that has basically forced banks to review the leverage ratios, unlike the hedge funds, is that the banks are regulated for capital, unlike hedge funds. So that means because of the need, and particularly Western banks, that they need to comply with Basel IV, the new capital regulations, etc. A very big component of how much capital you will allocate to a specific transaction and what return you are going to give to your own shareholders as a bank is the leverage ratio. Okay, and that is why it's going to stay, because if you think that shipping has changed or is going through massive change, we have to reflect how much change the banks have really suffered, and they will continue to suffer because of the increased regulation on banks. So this is going to stay, and as I said, we're not here to compete with the hedge funds. They're very fine to offer the 80, 90% up, and they can do so because they're not regulated, they don't have the same restrictions as we do.
If I may add on this one, we need also to take into account the changing regulations going to Basel IV, where there is an extra element of the relevant let's say, pledge position, because you can offer the gearing for 50, 60%, 70%, but the Basel IV compares it to the actual leverage of the company. So if you have a global guarantee and you have a holding structure, then you need to be better off compared to the existing leverage of the group. So there are different factors and different regulations kicking in, and we need to take this into account going forward.
I also have something to add to that. Fully agree with Eleni and Nikolaos. And just to give a couple of examples of the impact of the new regulations and accounting standards even that are coming into force. Already one of them came into force 1st of January, which is about leasing, which will have for some companies a tremendous effect. We're talking about an equity ratio that might have been considered to be, let's say, at 30%, suddenly overnight might go down to 10%. And then when you thought that you have a kind of a close to an investment grade shipping company and that you're providing financing on the back of that, suddenly you have a company with a B or B plus rating that's a huge change, which means allocating much more equity capital for that loan, which probably will make it a loss-making for a financial institution. So there are lots of things going on that only bits and pieces are seen by the SIP owners and the managers and the other parties, and it's basically our role, of course, to feed them through our financings to the community. But there are lots of things happening.
And if I'm going to say something that's going to make me hugely unpopular, the reality is that this is not going to have it doesn't just affect the leverage, it affects the tenor, and it's going to affect pricing as well. So you should brace yourself for the new reality that's going to come because of the increased regulation on banks.
And one more note, sorry for that, before we jump to the other one, is that what we have seen lately, at least in ADB, is we see that there is a secondary market opening up for loans. So you might start with a big bank, whichever bank is that, but because of the circumstances, if the deterioration of the underlying risk profile, there might, the loan might be up in the secondary market for sale. So that's also something that will happen. It's inevitable in a way because certain banks have certain restrictions and certain strategies and equity capital they would like to assign to a certain business, and if it doesn't fit them, fit that bucket they have, then
we'll get to Q&A in a second. I'm going to end with a very with a question that I didn't circulate in advance, but I think you'll be able to take it. Do you enjoy what you do, and what is it about the shipping industry? what is it about the shipping industry that you find special or interesting or different? And so start with Eleni.
So, bizarrely enough, yes, I do enjoy what I do right now, but I do have a masochist element in me, to be honest. And it's interesting because actually the people in the room who know me, they probably know that I don't have a shipping background. Actually, my background is on the corporate side, but I find shipping fascinating, to be honest. And I say that if I had to start my career from scratch now, I would start from shipping. And the reason for that is that because this is a fast-pacing sector. It's one sector where you see the actual relevance, and you see decision makers, quick decision making on the spot, basically able, to take decisions and discuss strategy on the spot, and that's not often what happens in in the industries outside shipping. I think the second aspect that I enjoy is that I think we Greek Cypriots, etc., and CS as one should be immensely proud for the position we have on the global economy with shipping, and that's not to be underestimated because it is something that we're extremely relevant in the global economy. We're extremely relevant in global trade, and that makes me feel good that every time we we do a transaction that basically is able to secure the buyer to the seller and bring the two people the two parties together, and being part of this chain offers you a very nice warm fuzzy feeling that you've been part of that. So I think shipping is here to stay, and it has proven, it's one of the sectors that has proven resilience over thousands of years really. Yeah.
Thank you. Iraklis?
Fully agree with Eleni, first of all. Just to add a couple of different twists to that. I work in a bank, obviously. The banks now are becoming more and more the gatekeepers of the financial industry. So the role is changing a bit. We have seen companies, fintech companies, coming up with solutions for providing financing, only lending to shipping groups. Those also probably will stay and develop further. But our role is slightly different. For example, we are getting immense pressure from regulators and everybody to implement new measures, more measures about KYC, who lend money to, what's the track record. And we have seen only a small piece of it. And the discussions that we're having with our partners are always a bit difficult, like, why do you need this information? And do you really need to go so in depth about it? Well, wait to see what's happening, what's coming further about that. So it's going to happen. and as I said, it's a different role. Now, what satisfies me a lot is that I play a role in that process and that part, which is great. And also, I like very much the shipping industry, the volatility of it. I will share something that Mr. Prokopiou tends to say in the last forums, that when we understand that it's stable within its instability, then it's a good place to be. And I understand that, and I like it very much. It satisfies me personally, not just from a professional point.
Well, thank you. And before we go to Q&A, Nikos, anything to add?
No, I just echo the comments, and I have to say that the industry keeps you on your toes as a professional. You need to be, always, up to speed, and you get the sense that even you are probably working at the same bank for a few years, you feel like you have 5 careers in over the tenure of this employment, because you need to have a different set of skills every year in order to serve the clients even better.
You didn't ask us if we enjoyed banking, though. It's probably that should be the next question.
One small comment, which I think we have to give some credit to bankers here, is that you shouldn't be so concerned or so at least guilty or feel guilty about the fact that you restrain yourself, or you say you're overwhelmed by masochism. It's not masochism, it's prudence. Because at the end of the day, it's the money, and it's the excess money which has been flowed into the banking, the shipping system, which actually has caused the disruption and the overcapacity and these massive ships which are coming out of left, right and centre. So effectively, the fact that banks sometimes restrain themselves from being lenders or do it on a more conservative basis, in the long term you're actually saving and you're actually promoting the health of the shipping industry. Thank you.
All right, so on to the Q&A. We can kick it off with, on the subject of clients that we derive great pleasure from working with. Polis Hajuanu from St. Paul. Do you have a question for the panel?
First, if the bankers can give us a reply to the question why in 2008-7, when ships were worth 80 million, they were lending 80%, and now they are worth 20 million, they're lending 50%. First question. Second question for Nikos. He knew when he made the initial comment about 3 or 4 competitive banks at very good spreads. He has to give us the names afterwards. Make our life easier.
Does anyone want to take the leverage question?
Start from the latter, because I think from the time I mentioned 3 or 4, I think now they are down to 1. I will speak, but we all know the usual suspects, and of course, very strong players in the market, but we feel, that the market will be increasingly regulated over the course of the years, maybe this year, so they will not be able to offer this kind of competitive terms, and it has to do with how you calibrate your models. I think we're running a paradox story here, where some of the banks are offering extremely competitive terms, some other strong players are offering extremely competitive terms as well, but they don't make returns. So we have a different players in the curve, and I think eventually everybody will end up in the same position. So this is at least my view.
I can add to that. I think the main problem, I would say, that's the right word, is there is so much liquidity, and it's still going on today and still happening today, and I'm a bit concerned, to be honest. I thought that when Fed was increasing the rates almost on a quarterly basis, that was okay, maybe a bit too fast, but that was towards the right direction. In Europe, we still face that. We have close to 0 rates for euro loans, and it doesn't help at all. Here we are, like 10 years down the road, and Europe is still in a big mess in a way. We have the Brexit, we have all kind of issues left and right. So it's a bit concerning about how this will develop going forward.
If I may speak to the first question myself. I think looking in retrospect, in hindsight, lending 80% at 80 million plus, Evalis has proven wrong. Both for the ship owner but also for the banks. So one good thing is that probably the industry has learned from that. So they're not doing the same stupid things they were doing 10 years ago, and also thanks to regulation, and we've become a lot more prudent, all of us. The reality is that you could say that shipping being a counter-cyclical sector, it should attract counter-cyclical lending. So banks should be more aggressive when there's a downturn because there's only upside, and more conservative when it's a booming market. The reality, however, is that banking is also driven by sentiment just as much as it's driven shipping is driven by sentiment. So when it's pouring outside, it's not very easy to go to your credit committees, and when they don't know whether the cash flow will be sufficient to meet OPEX without any visibility for the next 12 months, not even, to basically go there and say, you know what, this is a good investment just on the basis of value. Let's do 70% lending. It just doesn't fly because they want to be able to see that the cash flow will be certain, will be there to comfortably meet debt service, and then the value of the collateral should be a secondary option, when the cash flow is not sufficient. So this is how it works in reality. But I think it is a good thing that we're not doing what we used to do in 2007, 2008, and yourselves alike.
Well, thank you for the question, and thank you to the panelists for a great discussion. We'll step aside, and you can we'll go to the capital markets panel. Thanks.
Thank you. Thank you.